let me ask you a question. If trading is one of the biggest financial opportunities in the world, why do so many traders fail? Every day, millions of people open trading accounts hoping to make money from the markets. Some spend months learning, others years. They watch videos, they buy courses, they learn strategies, they study charts. And yet, most of them never become consistently profitable. In fact, the vast majority eventually lose money. So what exactly is happening? Why do so many traders fail while a small percentage continue to succeed year after year? That's exactly what we're going to explore in this video. One of the biggest mistakes traders make is believing that knowledge alone is enough. They think that if they learn enough strategies, watch enough videos, or study enough charts, success will eventually come. But the market doesn't reward knowledge alone. It rewards discipline. And that's where many traders begin to struggle. Because discipline sounds simple until real money is involved. It's easy to say you'll wait for the perfect setup, but when the market starts moving, patience suddenly becomes difficult. It's easy to say you'll follow your trading plan, but after a few losses, emotions start looking for shortcuts. It's easy to say you'll respect your risk management rules, but when greed appears, those rules often get ignored. And that's why so many traders remain stuck, not because they don't know what to do, but because they fail to do it consistently. The truth is, most traders already know the basics. They know they shouldn't overtrade. They know they shouldn't revenge trade. They know they should wait for quality setups. They know they should control risk. The problem isn't information. The problem is execution. Professional traders understand this. That's why they focus less on finding new strategies and more on building disciplined habits. Because they know that a simple strategy executed with discipline will often outperform a complex strategy executed emotionally. And over time, the gap between disciplined traders and undisciplined traders becomes enormous. One follows a plan, the other follows emotions. One remains patient, the other becomes impulsive. One protects capital, the other takes unnecessary risks, and eventually their results begin to reflect those decisions. That's why discipline is often the invisible line separating the small percentage of traders who succeed from the overwhelming majority who fail. As traders gain experience, they eventually discover something that many learn the hard way. It's not the losses that destroy accounts, it's the size of those losses. And that's where poor risk management becomes dangerous. Many traders spend countless hours looking for better entries, better indicators, better strategies, but very little time learning how to protect their money. They become obsessed with making money while ignoring the importance of keeping it. And the market punishes that mistake quickly. A trader might have a great strategy. A trader might even predict market direction correctly most of the time. But if they risk too much on a single trade, one mistake can erase weeks or even months of progress. That's why so many traders find themselves trapped in a cycle. They make profits, then give them back. They grow an account, then destroy it, not because they lack skill, but because they never learned to respect risk. Professional traders understand something that losing traders often overlook. Survival comes first, because if your account survives, you can always find another opportunity, another setup, another trade. But if your account is severely damaged, your opportunities become limited. That's why successful traders think about protection before profit. Before entering a trade, they're already asking, what happens if I'm wrong? Because they know that every trade carries uncertainty. No setup is guaranteed, no strategy wins every time, and the traders who last the longest are usually the ones who respect that reality. The market rewards those who manage risk and punishes those who ignore it. That's why poor risk management quietly destroys more traders than bad strategies ever will. Even when traders have a solid strategy and understand risk management, their emotions often become the real problem. Because trading is one of the few professions where fear and greed can directly influence every decision. And if those emotions aren't controlled, they can destroy months of hard work in a matter of minutes. Fear causes traders to close winning trades too early. They see a little profit and immediately panic. Instead of following the plan, they follow their emotions. Greed creates the opposite problem. A trader reaches their target, but they want more, so they stay in the trade. Then the market reverses, and what should have been a successful trade becomes a disappointing one. Frustration is just as dangerous. After a loss, many traders feel the need to immediately win their money back. They start forcing trades, ignoring rules, taking setups they would normally avoid. And before they realize it, one bad decision turns into several. The market doesn't care how frustrated you are. It doesn't care how badly you want to recover a loss. It simply responds to your decisions, and emotional decisions are usually expensive ones. That's why many traders know exactly what they should do, yet still fail to do it. Their emotions become stronger than their discipline. Professional traders understand this. They know that emotions never completely disappear. Fear still exists. Greed still exists, frustration still exists. The difference is that professionals don't allow those emotions to make decisions for them. They trust their process, they trust their rules, and they remain disciplined even when emotions are telling them to do the opposite. Because they understand that consistency becomes impossible when emotions are controlling the account. And, over time, emotional trading quietly pushes countless traders into the 95% who never succeed. And this often leads traders into another trap: overleveraging. The desire to make more money in less time. At first, it sounds reasonable. If a small position can make money, then a bigger position should make even more. That's how many traders think, but that's also how many accounts disappear. Because leverage is a double-edged sword. It can magnify profits, but it can magnify losses just as quickly. And most traders don't fully understand that until they experience it themselves. A small market movement that would normally be manageable suddenly becomes a major loss. Emotions become stronger, fear becomes stronger, pressure becomes stronger, and discipline begins to disappear. That's why over-leveraged traders often make the worst decisions. They're no longer thinking clearly. They're watching every tick, every candle, every small movement. Because too much money is at stake. The trade becomes emotional before it even begins. Professional traders rarely think this way. They understand that surviving is more important than getting rich quickly. They know that consistent growth beats reckless growth. That's why they focus on position sizing. They focus on capital preservation. They focus on staying in the game. Because they understand a simple truth. You don't need one huge trade to become successful. You need hundreds of disciplined decisions over time. But over-leveraging convinces traders to chase shortcuts, and shortcuts often lead to the same destination, a blown account. That's why so many traders end up in the 95%, not because they couldn't become successful, but because they tried to get there too quickly. As if all of that wasn't enough, many traders simply don't have the patience required to succeed. They want results immediately. They want profits this week. They want consistency this month. They want financial freedom as quickly as possible. And that impatience becomes a serious obstacle because trading doesn't reward speed, it rewards discipline. The market doesn't care how badly you want success. It doesn't care how long you've been waiting. Opportunities appear when they appear, not when you need them. Yet many traders struggle to accept this. After sitting on the sidelines for a while, they become restless. They start looking for trades that aren't really there. They lower their standards. They convince themselves that an average setup is a good setup, and suddenly they're taking trades they would have ignored if they had remained patient. The irony is that patience often looks like doing nothing, and for many traders, doing nothing feels uncomfortable. They feel like they should always be active, always trading, always chasing the next opportunity. But professional traders understand something different. Sometimes the best trade is no trade at all. Sometimes protecting capital is more important than forcing an opportunity. And sometimes waiting is the most profitable decision you can make. That's why successful traders are willing to sit through boredom. They're willing to wait for quality. They're willing to let opportunities come to them because they know that patience isn't weakness, it's an advantage. The market will always provide another setup, another opportunity, another chance. But impatient traders rarely wait long enough to see it. And that's why so many end up joining the 95%, not because they lacked skill, but because they lacked the patience to let that skill work over time. Then there's something else that quietly destroys a lot of traders: following the crowd. Many people enter the market without a plan of their own, so they look to others for direction. They follow social media traders. They follow online groups. They follow market hype. And before they know it, they're making decisions based on what everyone else is doing, not on their own analysis, not on their own strategy. And that's dangerous, because by the time the crowd becomes excited about an opportunity, the smart money is often already positioned. Think about it. When everyone is talking about buying, who is left to buy? When everyone believes a market can only go higher, that's often when risk is at its highest. But crowd psychology is powerful. People naturally feel safer doing what everyone else is doing. It feels comfortable. It feels reassuring. But the market doesn't reward comfort. It rewards discipline and independent thinking. That's why professional traders rarely make decisions based on public excitement. They're not interested in following the crowd. They're interested in following their process. If a trade fits their rules, they take it. If it doesn't, they walk away. No matter what social media says, no matter what influencers say, no matter what everyone else is doing. Because they understand that the crowd is often driven by emotion, fear, greed, excitement, and those emotions rarely lead to consistent results. The traders who succeed learn to think for themselves. They trust their analysis, they trust their risk management, and they understand that popularity is not the same thing as probability. Just because everyone believes something doesn't make it true. And that's another reason so many traders end up in the 95%. They're following the crowd, while the professionals are following a plan. And perhaps the biggest mistake of all. Many traders enter the market without a real edge. They have indicators, they have charts, they have strategies they found online. But they don't actually know whether those strategies work. They've never tested them properly. They've never gathered enough data. They're simply hoping. And hope is not an edge. An edge is something that gives you a probability advantage over time. It's a method that has been tested, refined, repeated, proven through experience. Without an edge, trading becomes little more than guessing, and the market is a very expensive place to guess. That's why many traders experience the same frustrating cycle. A few winning trades make them believe they've found the answer. Then a series of losses takes everything back. They switch strategies, change indicators, look for a new system, and the cycle starts again. Not because the market is impossible, but because they never developed confidence in a genuine edge. Professional traders understand this. They don't jump from strategy to strategy every week. They spend years refining what works, testing it, improving it, learning its strengths and weaknesses, because they know that consistency comes from repeatedly applying an edge over time. And once you combine a real edge with discipline, risk management, patience, and emotional control, you begin to separate yourself from the crowd. That's where the difference starts to appear, because the market doesn't reward traders for being busy. It rewards traders for having an advantage and executing it consistently. And without that advantage, even the hardest working trader can find themselves trapped among the 95% who never succeed.
So remember this. The 95% don't lose because they're not smart enough. They lose because they lack discipline, ignore risk, let emotions control decisions, chase the crowd, and never develop a real edge. The 5% who succeed aren't looking for shortcuts. They're focused on patience, consistency, and execution. Because in trading, success doesn't come from one big trade. It comes from making the right decisions over and over again. And that's what separates the 5% from the 95%. Thanks for watching, and I'll see you in the next video.